Hey everyone, and welcome to a new episode of Money Macro Talks, where I, Joeri Schasfoort, an economist, talk to guests that can help us understand the global economy a little bit better. Today, I'm talking to Thomas Bollen, a financial/investigative journalist at Follow the Money. Now, what's really interesting, I think, is Thomas is an expert on money creation. He has been campaigning in the Netherlands for years and years now, for a serious debate about who creates money in our societies, and then also, should the institutions that currently create money, should they actually create money? What are the consequences for our economy, inequality, whether or not our economy thrives, and a whole lot more. CBDCs, stablecoins. We're going to talk about a lot of that because Thomas has been working for years on a book, and it's out now. It is, to my understanding, now out in Dutch, but it's also to be translated to some other languages. And the title of the book essentially translates to "There is plenty of money, just not for you." Thomas, welcome. Thank you for coming on.
Yeah, great
This
to
this
be here, Joeri.
this title, I love it, honestly. Having to think about YouTube titles all the time, I think it's just so catchy. And I think there's a deeper meaning to it, probably, I'd guess at least. Can you maybe talk a little bit about the title? What does it mean?
Yeah, so plenty of money. Especially in Dutch, it sounds good. Genoeg geld. Geld genoeg, maar niet voor jou. I think the literal translation might lose a bit of what it has in Dutch, but it's about plenty of money because there's money enough. We can create money, and it just doesn't flow to all the places in our society. And I wanted to highlight that because the book is about money creation. Who does that? Why are these institutions allowed to do that? Create money. And there's just this misconception of how money works. Like most people that I talk to, and also people within banks, don't realize they work for money creating institutions. So it's one of the things that amazes me that 15 years after the crisis of 2008, we still don't all have this the same conception of how money works. And I didn't know it when I started investigating this topic. So I was thinking there's this set amount of money, and that's what circulates through our economy. And I didn't really realize there's money creation and money destruction. And I wanted to create awareness for that topic because I think, as you mentioned, it's really an important factor in our society. It determines how our economy works and who benefits from certain activities. Yeah.
Could a non-literal English translation for your title be, I was just thinking about this, like, could it be "There's infinite money, it's just not for you"?
Yeah,
Because
maybe.
there's infinite money, right? Like, money is not scarce. I think that's part of what you were trying to say in Dutch, because banks can, in theory, at least, create infinite money. Yeah, what do you think about that? There's infinite
Yeah.
money. Is that correct?
Well, yeah, infinite money.
Mm.
Well, I think we shouldn't create infinite money because it would lose its value. But I think it's important to be aware that the money supply grows and shrinks all the time, and that this has huge effects on our economy and our society. So it's something that we need to debate because it has. It's a political topic. It's part of the political economy. And there have been debates about money creation in the past for centuries. And it's always been this debate, like who is best suited to have the power over the printing presses. Should it be the king, a public institution, or should it be private banks? And that debate kind of has been lost for some time, and then it re-emerged after the crisis of 2008, and that's what I try to catch in my book. So I talk about all these movements that came up after the big crisis of 2008 that started started to ask the same questions as I did. Well, where does all this money for these mortgages come from? And that's where kind of my expedition started, and I encountered a lot of people that asked these same questions.
And in a nutshell, isn't it that most people think, look, banks take your money and then they lend it out. But the reality is that private banks create the vast majority of the money as debt, right? I have a mortgage. I went to the bank. I said, can I have a mortgage to buy my house? The bank creates on both sides of its balance sheet a debt contract with me. I have to pay the bank in the future. That's the mortgage. It's an asset for the bank. And the bank owes me cash, essentially, if I want to. But, typically I don't want to because I just pay with bank money. That's a deposit. A deposit is on the liability side of the bank. And so two contracts have been created. The deposits are money, and hence the bank has created money out of thin air when I went there to get my mortgage. But it's not free for the bank per se. They can't do this infinitely because they have the risk then that I transfer that money I wanted to transfer it into cash, and they may not be able to accommodate that. Would that be a good summary, you think,
Yeah, I
or
think
is there more
that's
to
a
it?
good summary, and I think that there's some sort of paradox because the bank needs to have a balanced book, so there need to be assets and liabilities need to be in balance, and that kind of conception that is kind of puzzling. So if the bank creates this asset and a deposit, if you take the deposit to another bank, this bank needs to attract some other depositor or borrow money somewhere else. So it still needs to balance its books. So that is still valid, but it's not like you said that they have the depositor's money and then lend it out to people who want to borrow for buying a house or starting a company. And that is something, these two things that are both valid at the same time, they're very confusing. And yeah, we talked to for the research of the book, I talked to a lot of people and also within banks, and we also had conversations with bank CEOs and the chief economists. And then there's always these stories that the chief economists tried to explain to the CEOs how their institution functions, that they are money creating institutions. And then we had conversations with the CEOs, and then they still struggled to fathom this mechanism, and they explained it many times that it still is deposits that they lend out to other people. So it's a difficult thing to grasp, and yeah, I think that's that makes it also hard to talk about this topic, because if you don't share the same conception of what the reality is, then it becomes really hard to talk about the system and how we can improve it. And this idea of banks as just intermediaries between savers and borrowers, that's something that's stuck in our heads. Like it's the way we learned it in school, and it's still being taught. And even the recent Nobel Prize, not the last one, but the year before, for Ben Bernanke, there was also a description that fitted this kind of intermediary role of banks. So I think it's still not something that everybody, completely understands.
Yeah. And then, well, luckily we are on the same page. We have studied this for a very long time. Hopefully a lot of viewers or listeners to this interview as well, if they watch Money in Macro, I talk about this in quite a few videos that are on banking. The easiest way to see it, I think, is to draw a balance sheet and just to see that indeed banks create money. We agree on this.
Yeah,
It's not free for them. It's risky business, but still they do it. So I think we are sort of on the same page, and I think hopefully most listeners as well. And that hopefully allows us to really get into the meat of your book, because I don't think your book is about this fact, right?
No.
So what is the core of your book? Given that we know that private banks create money.
Yeah. So the book is the reason I wrote the book is to create more understanding of our financial system, especially this money creation process and the effects of that process on our society. So to improve financial literacy. So I wanted to explain it to normal people who don't have an economic background, who cannot read a balance sheet, for example. So then it becomes more complicated to understand it. But I think it's important that we don't all have to read balance sheets, but we all have to understand what the effects of money creation in our society are. So that was the reason for me to write the book. And then I was struggling, like the first drafts is just another explanation of the kind of things that we just discussed. And it became very systemic, like a school book, very boring. So my editor said, okay, this is not what we want. We want a nice book to read with stories, with people who experience things and scenes and funny jokes. So there was only one way that I could tell it. I needed to find the people who've been asking these questions and who've been researching this topic and who started campaigning for reform of the system. And that's what I did. So I followed these movements that came up all over the world after the 2008 financial crisis, because that was the moment that there was attention for banks and money creation. So I followed Positive Money in the UK, Ons Geld in the Netherlands, Vol Geld, the referendum in Switzerland. That got a lot of attention at the time in 2018. And I followed some scholars who've been campaigning for monetary reform. And I explain by describing their exploration, you slowly kind of understand what is happening in the financial system. And then I also wanted to show like the how political it is, and how money is in the end it's power, and there are people profiting a lot from the current system. So they encountered a lot of lobby power from the banking sector. So my book is also a political book. It's about the forces that want to keep the system as it is, and the people who want to change it. And during that story, I kind of explain why it's such an important topic. I don't know if you want to dive into that right now or keep that for later.
No, absolutely. I think a great starting point would be like, why do we need reform of the system, of the monetary financial system that we have today, where the central bank creates some money and then private banks create almost, by far most of the money. Why would we need to reform that?
Yeah.
The crisis has been a long time ago. We haven't seen such a big crisis since, so maybe it's already fixed and we don't need to worry about it.
Yeah. So there's a lot of reasons why you could suggest that a change is necessary. So let's first talk about money creation and who creates the money. Just apart from crisis, I think it's important that to realize that if you create new money, that goes to somewhere in our economy. So if you create a lot of money for buying existing houses, house prices will rise. And if you create a lot of money for small and medium enterprises, then they have money to invest and start up a business. And if you create a lot of money for big corporations to buy up their competitors, then you get market concentration and monopolies. So money creation is influencing the way our economy develops. And what we see right now is, and that's also related to 2008, but we see it in many European countries and the US as well, that money creation for housing is very attractive for banks. They
Mhm.
can make money. They have um, collateral, so it's for them a less risky uh, destination for the money to make money for housing, and then for, let's say, making money for small and medium enterprises, and that is really causing house prices to rise in many countries. And at the same time, our politicians are talking about the housing prices of cost of living crisis. And I find that amazing. Like, how can you talk about the housing crisis and not discuss money creation at all? And so I think that's a really important reason why we have to talk about this, because it's creating problems in other areas of our economy.
Okay,
Uh,
so I think there's some really interesting parts there that I want to focus on. The first is you're saying, look, money creation is not neutral, right?
yeah,
Where you allocate money, that empowers the sector that receives money. I think there's been a lot of academic work on that, sort of exploring. Look, if you want to develop an economy, lots of success stories have had these banks that have been manipulated or controlled somewhat by the government to invest in certain sectors, like the development of Japan. You had window guidance, for example, where the Japanese banks were told by the government, look, you have to invest in infrastructure and you have to invest in certain industries that are export oriented. The Chinese did this as well. So that's one way you could have banks, I guess, deliver something, a change in the economy. Then and then you're saying, but actually since years now in the West, there's been this shift going on towards financialization, I guess is the academic term, right? Like towards mortgages, towards mergers and acquisitions. Banks are creating more and more money to that. And then maybe a really interesting recent example is China's housing bubble popped. Then now we are being swarmed by electric vehicles all over the world and batteries, etc. And there are actually graphs from academics that show that the Chinese state has forced banks or given them very strong incentives to send all the money towards these new industrial sectors. So money creation is a very powerful thing. That's, I guess one.
yeah, yeah.
My question is
And
then if you agree, and then two is, but it's bad to use that for mortgages and financial stuff, and it's good to use that for productive purposes. Is
yeah, I
that
think
correct?
like that's the kind of the general thing. If you send it to our productive economy and you lend out and create money for businesses that are actually going to produce stuff that we need and can use, that's beneficial. That's our economy. Then it's fueling our economy. But if you create a lot of debt for private equity companies just to buy up our other companies and then sell them at a higher price to another private equity company, um, that is fueling financialization and market concentration. And that's I think that's something that we don't talk enough about. And private equity is for example, that's something um, in the Netherlands, there's been a lot of discussion because they've been buying up these health companies and hospitals and um, like public sector companies, and then the quality of our healthcare may go backward. So that's really an issue. But then private equity, that's suggests is just rich people putting their own money up, and that's the free market. But then we don't really realize that apart from that money they bring in, it's like 3 or 4 times that amount in new money which is being created by banks, that's also being used by these companies. So if we wouldn't allow say, money creation for private equity, the amount of money going around in that part of our financial economy would be 1/5 of the amount going round right now. So we're really fueling things that we actively say, well, maybe it's not that beneficial to our society. And I think that's a key thing, because well, why are we doing it then? Because we can design the system to be different. And for example, the credit guidance idea, like there's so many flavors of how you can do it differently, and it's not like cutting out the private sector. It's not like public money creation and then no private money creation at all. That would be like an extreme. But we can also say, okay, if we allow these private institutions called banks to create the public money, because we allow them to create the euro or the dollar, then we can say, okay, we want it to go into the productive economy. And I think this is really something that should be a part of political discussions. And it really isn't.
No, yeah, that's true. So indeed, credit guidance or window guidance, what they do in China is not on the radar in America, Europe, the Netherlands. So this is one thing that could be reformed. You mentioned, well, I want to get into the political backlash that you mentioned, which sounds very interesting. But before that, are there other reforms that are interesting?
Yeah, I think because you asked what are the problems, I think there's, so this is the one side, okay, where you create money for, that's where the economy will thrive. And if you create too much money for financialization for the financial economy, then the financial economy will thrive, but it will blow up house prices, asset prices, and we will get a backlash at some point. And then the second part of the equation is like the financial stability aspect of it, because the 2008 crisis, there was too much money creation for mortgages that were very risky, and then they were being sold. Nobody saw the risks anymore. And then the banks turned out to be all interconnected and they had to be saved. So there was public money creation in the aftermath that was going to propping up the current system. And I think this is also like the way public money creation is being used right now is not an active thing, as in going into our economy, but only afterwards. So to replace the private money creation and to go after the private money creation. And I think that is also an extra reason to be extra cautious, because this means that the public money is the safety net behind all the private money. And I think that is a mashup of private and public interests. And that's also what many scientists have said. And in the Netherlands, I described the campaigners of Ons Geld, who actually managed to get a debate in our parliament. And then the Dutch Scientific Council, they came out with this report, and they were also basically undescribing their analysis and saying, okay, we have too much debt and money creation because the private sector, well, does this whenever they can make a profit, and they don't really account for the effects in society. So they can create bubbles that will later pop. And then if we have to back up the system afterwards, that is costing the public money. So we should separate these two more. And I think that's another reason why we really need to talk about this.
Separate what? Private money creation and public money creation? Or?
Yes. So separate the part of the banking system, so payments and savings, from the more risky investments and loans. And because in the current system, this is all mashed up. So as I mentioned at the start, if you have money on the bank, you're kind of financing your bank. Your money is not in a vault somewhere. It is. It's not there. It's backed. Your money is backed by the assets of the bank. So you're financing your bank. That's the kind of um, setup.
Yeah.
And that means then whenever there's a bank run and people are asking for their money at the same time, well, the bank has to sell all the assets, which cannot be done within such a short period of time. So the bank would go bankrupt if the state wouldn't step in, and that is the point where they always step in, because you just cannot let that happen. So all the central bankers and politicians that I talk to explain what at such a moment when a crisis is happening, there's no way we can allow the banks to go down, because it would the savings of people would be gone, and we would lose the payment system, because we are so reliant on banks for payments. So yeah, this setup with everything at the same place gives doesn't allow for banks to go bankrupt. So there's no real private sector there, and that's a setup that doesn't really fit in well with the normal rules of capitalism.
Yeah, I think a lot of people have intuitively a feeling for this, right? A lot of the protest movements after the great financial crisis, I think both on the left and right politically, I've talked a lot about why are we bailing out the banks? And then on my channel, when I do analysis sometimes of several economies, I always say, look, in many cases, you have to bail out the banks, which is exactly what you're saying, because otherwise your economy is just going to collapse. It's like you have to bail out water companies because you need water, and you need money, you need payments, and you need money creation in any economy. But what you are suggesting is that you can reform the system in such a way, and please correct me if I'm wrong, but that you still have banks do payments and savings from regular people, but those can only invest in super safe stuff, where safe stuff is crucially probably not mortgages.
Yeah.
And then you have the speculative banks doing other stuff.
Yeah, and that's a setup we had before, like in the US after the crisis of the 1930s. These things were separated, but then through lobbying, gradually that system changed, and banks were allowed to use the savings of people to finance more risky undertakings. So that messed up again, and yeah, it's strange that in the 1930s they were very clear. Okay, we should separate these things, and there were more fundamental reforms on the table to say, okay, we shouldn't allow this at all. We should have full reserve banking, and that would mean just guarding your money safely, and then everything else, which is finance, and that should be more equity funded, or long-term loans where you actually are aware that you are financing your bank, and if I finance something, I can make a profit, but I can also lose some money. And in 2008 these things weren't on the table at all, and I think 2023, for example, the banking crisis in the US when Silicon Valley Bank went bankrupt was a good example of that. The fact that all these fundamental flaws, the design flaws in the system, are still there, because what they said after 2008 was, we're gonna all deposits up to $250,000 were guaranteed by the government institution, and then for the rest we have resolution mechanisms, so we can do like the bankruptcy quicker, and all these plans, they just went out of the window when the crisis happened. And the venture capitalists in Silicon Valley, and also people like David Sachs and Elon Musk, who are now really close to Donald Trump, back then were kind of blackmailing Joe Biden and his government to step in and back up their money as well. And I describe these guys like Peter Thiel, who had 50 million on the Silicon Valley Bank. Well, he would normally have to take a loss, but because the pressure on the government was so big from these tech guys, they were just saying, okay, if you don't bail us out right now, all the other banks will fall again. And they were saying something that I found intriguing, like either a dollar is safe or it's not. And I think that's actually kind of a plea for a full reserve bank, where you have safe dollars, and then next to that we have investments. And you should be aware that if you take more risk and you have an upside, you get more interest or more profits, then that means you can also lose some money, and it can also be a loss of 10 or 20%, and I think that should be accepted.
So actually, I want to ask you a question about the full reserve banking proposal. I think it's also now, if people want to know more about it, Google the Chicago Plan. This was in the 1930s. They wanted full reserve banking. It got pretty close. Wasn't the Swiss proposal also about, was it also about full reserve banking?
Yeah.
Yeah, it also got pretty close, right? It didn't pass, but
yeah, it was
close,
called sovereign money, so it was a bit different, but it came down to the same thing. Yeah.
But what I don't always understand about full reserve banking. Okay, in the past, when we had a gold standard, I got it. Like there were a couple of sort of full reserve banks for a while. They just had gold in the vault, and then they created deposits. All deposits were backed by gold. It's simple. But these days we don't have that system, right? So what is a full reserve bank today? What does it look like?
It would be fully backed with central bank reserves.
Okay.
So
yeah,
I think this distinction is important. We have public money, and that's the cash notes in our wallets, and then we have a digital form of this public money created by central banks, but we don't have access to it, and that's the central bank reserves. And if you would have a digital form of cash or a bank account fully backed by central bank reserves, that would be the equivalent of a full reserve bank.
But then, wouldn't you better have a CBDC where, I mean, what's the use of having a private bank that just buys essentially or holds 100% central bank reserves? Isn't it more logical then to have the people hold central bank reserves, essentially?
Yeah, but this debate of central bank digital currency, that kind of came up after, that started around 2016 in Europe. I think like in China, they started in 2014, and we saw the first people mention it around that year, 14, 15, but 2016 and until 19, there was central bank digital currency discussions, and that was kind of the first conception of this idea. Okay, we have a digital currency inspired by all the Bitcoin and cryptocurrencies coming up, and then why not have the central bank issue such a coin? But I think the concept is still the same. You would have direct access to the central bank balance sheet, and if it's an account or it's a coin or whatever form you can imagine, it will mean that you have direct access to the safe money of the central bank, and there's no credit risk on an intermediary, on a bank or whatever company is in between. So it would be registered with the central bank, and if the app that you're using, if that app builder goes bankrupt, it's still your money because it's registered in your name at the central bank or on the blockchain.
Yeah. Okay. So I think that's actually kind of interesting that you could see these two proposals as being part of the same family. I guess, where you
Yeah.
say, look, there could be a full reserve bank that's public, but it's not the central bank. Could also be, I could guess you could also have a market-based system where you have full reserve banks. You just say, look, you have to have fully backed by central bank reserves, but we pay an interest rate on central bank reserves. The way you make money as a full reserve bank is paying your customers a little bit less, and then you should offer very good payment services to your customers. I could imagine that being the business then, and that you have multiple of those, and that way you get better a better payment system because you have the market doing it rather than the central bank. In both of those cases, it's clear to me that you get rid of the big problem that you described, the fact that the public has to bail out risk-taking actors, right? That's why you would do that.
That's the ultimate goal of it. So all these reformers that I followed, and I talked to them back then because I started as a financial journalist 10 years ago, and I started following their initiatives. And in the Netherlands, we had this full reserve bank initiative, and they thought, well, we cannot wait for the central bank to do this. We're gonna do it ourselves. We are much more agile. We can do it quicker, and they got traction because in our parliament, like everybody said, like all of the 150 parliamentarians said, okay, you should be allowed to start a safe bank that doesn't loan out money, that just keeps your money safe. It would be like the digital equivalent of keeping money in a sock under your mattress. That should be there, but they weren't allowed to start their company with all the banking rules. They had to be part of this deposit insurance scheme, and they would have to contribute to that scheme. So the current system in the Netherlands, at least, is that the banks all have to pay into a certain scheme, and then the government is the ultimate backstopper. But it's first this amount of money that the banks have provided, and it's not enough to save a big bank, but it's enough to save a really small bank. But if you are a full reserve bank, they said we don't want to contribute to that, because then we would be paying in for saving other banks. That we would have to pay for the risk that other banks are taking. So their ultimate goal would be to bring back this awareness that you have safe money and then you have risky other assets, riskier money, if it's still within the bank. So, but it would mean that we, the people, would have an incentive to keep our money safe, because we know if we keep it at other places, we can lose some money. So there should be this distinction. So it comes with educating the population as well about money, and ultimately also scaling down these safety nets and guarantees for regular banks. Because otherwise, why would you keep your money in a full reserve bank where you would get no interest, while you know that if you keep your money with a commercial bank that takes risks, you get interest, but still your money is being backed up by the government ultimately? That would make no sense. So the full reserve bank makes only sense within a certain mindset that there are problems with the current setup of the system. And that is kind of strange, because after 2008, all these committees were started, like how can we make sure this never happens again. And one of the, in all these committees, they always said, okay, these deposit insurance schemes, they're good to prevent a bank run, but ultimately this is not a sound system, because you create moral hazard for banks to take more risks and more risk, because they know ultimately they will be backed up by the government. And they also said scale down the deposit insurance schemes, but that never happened in any of the countries. So instead, all European countries still have a deposit insurance scheme till 100,000 euros, and in the US it's 250,000, and it's now implicitly everything, because even the people with 50 million in the bank were saved at Silicon Valley Bank. So banks know that ultimately the government will back up the current system, and that's great for them because that gives them cheap financing through deposits, while the government is actually bearing the risk. So we are all, as part of as taxpayers and as part of the population, are bearing the risks while the profits go to the banks, and it's actually increasing the moral hazard and risk taking. So this to change the system, we first have to acknowledge again that this is a strange setup that has some severe downsides as well, and not just saying okay it's fine because the risk of bank runs is now smaller.
Yeah. No, I think I see what you mean in the sense that, look, this system that we have now is not a designed system per se. It's been evolved, right? It's developed over hundreds of years, and you had no deposit insurance. You had all of these bank runs, and then you had deposit insurance was introduced. It did solve a lot of these problems, but of course, as you mentioned, at a cost, and also at a sort of political cost that, yeah, you cannot have full reserve banks today. I totally agree with you. While deposit insurance, there's two things. They cannot pay into, they shouldn't have to pay into deposit insurance. And then, of course, too, actually, you should have no deposit insurance at all if you really want a thriving market for full reserve banks.
Yeah. Safety right now is not a parameter that is significant in choosing a bank, because all banks, my deposit is guaranteed. So I should take if you rationalize your choice, you should go for the bank that takes most risks and pays the highest interest, because your money is still safe there.
Yeah.
That's not
indeed. Yeah, so that's very interesting, and that also influences the CBDC alternative to this idea, because I think it's probably in your book. I'm not sure. Let me know. I didn't get to the CBDC chapter yet, but
it's definitely in there.
So how does deposit? We've already talked about. Look, CBDC is an alternative for the full reserve system if you implement it fully, but it's not going to be implemented fully in Europe. There's a good chance. I think it might be implemented, but it's not implemented fully, right? Like, can you explain a little bit about the current CBDC idea and whether or not this will fix any problem at all?
Yeah, and we should also talk about stable coins, because I think that would be an interesting one as well. But your question.
Where do you want to start? You can also start with stable coins if you want, and then move to CBDC. I think what do you prefer?
If we are talking about full reserve banking, like the promise of stable coins is sort of a private full reserve bank. If they actually deliver on their promises. So if you right now have a lot of companies saying, okay, we have a stable coin, you get a coin that's worth $1 or €1, but mostly dollars, and then we back it up with money on a bank account. That was the initial promise. Like the first big stablecoin, Tether, had this written on their website. It was a digital coin which could be used on the crypto exchanges, and you would be able to sell your Bitcoin and have some asset which is always worth $1. So it would function as your money, but it would allow you to not have to transfer all the money back to a bank account, because that was very burdensome, especially at that time in 2017-18. So they said, okay, this is one-on-one backed with money on a bank account. So I saw it as as a new layer of money on top of our bank money. So the core of our system is the public money, the central bank notes and central bank reserves. Then we have bank deposits as a second layer on top, and then we would get a third layer of stablecoin stablecoins. Yeah.
Yeah.
Um,
But so indeed, that's very interesting. It's the full reserve banking idea. Oh, that sounds very safe, Thomas. But in my mind, tether is very risky.
Yeah.
How can that be?
Yeah. So after a while, they replaced that one-on-one backing with dollars on a bank account, and they said, okay, we back it with something, and nobody really knows what that something is. But they became very big, so there were a lot of people who found it very handy and or did believe that it was safe, and it grew to $150 billion right now, and right now they back it with mostly government debt, U.S. government debt, treasuries. So it is quite safe. It is backed by one of the safest assets that you have in the financial markets. So there's still a risk, but it's quite safe, and it can be
But
even
that's not 100% though, right? Like, we
No.
don't know. Isn't that true?
No,
I have read in the Financial Times, I think last week or 2 weeks ago, that they also are investors in certain very risky businesses.
Yeah, the problem is that they don't allow auditors to fully audit their books, so it's you never know what's in there, and that makes it and they're very dodgy companies. They're somewhere on the British Virgin Islands, and the founders had some sketchy history, so it's not really the kind of bank, the trusted bank that you you would normally go for. But somehow it doesn't really matter in this crypto world. But you do have a stable coin would be really stable. It would if it were 100% backed with central bank reserves, and that's actually what China is doing with their Alipay and Tencent money apps. So these are sort of stable coins that are fully backed with central bank reserves. And so I see the stable coin realm as a promise of full reserve banking, and it could actually be full reserve banking where it's 100% backed with central bank reserves or government debt, government bonds, and then there's also the option of doing what a bank does and invest in riskier assets. So then it becomes an investment bank, but it's still called a stablecoin. So that's where they mix up banking and full reserve banking. So actually, it looks a lot like the way banking emerged and developed from being full reserve banks to fractional reserve banks and creating loans and stuff like that. So it's it's sort of parallel universe where banking is reinvented.
Yeah, but doesn't it indeed? I mean, this reminded me immediately of the Bank of Amsterdam, which was a public bank of the city of Amsterdam, and they were a full reserve bank. They were promised to have fully backed in gold, and then over time it changed. The Netherlands fought a couple of wars. They started investing in the VOC company and the government war spending, etc., etc. And then until a point where people no longer trusted it, and there was a run. And that sounds indeed like history repeating all over again. But that does lead me to ask a question: is full reserve banking fundamentally unstable if it's not regulated?
Well, if it's not regulated and you allow these institutions to say, okay, your money is is fully safe, like stable coin. It's 100% stable, but at the same time you're gonna back it with risky assets. That's a flawed promise, and so yeah, there need to be rules. If you call something a stable coin, it needs to be backed by central bank reserves or government bonds or whatever you allow within the range of safety and stability. And I think that's where the debate comes in. Okay, if we have this new category of money where the promise is this is stable money because it's backed with less risky assets than regular banks back their deposits with, then it would be some sort of separation of money and investment. So I see it as a promising new development, in which the market kind of brings this separation, but then it all comes down to do they actually back it up with these safe assets, and therefore regulation is adamant, because otherwise you see time and again companies will start to cheat with what they promise and take more risks than they say, and then this is why the discussion about stablecoins is right now in the center of attention from the banks and the central banks, because if stablecoins are going to grow bigger and become more important outside of trading crypto coins, then the fear of these central banks is that they will become systemic. They will become as important for our regular economy as banks are, or at least they become important enough to not let them go bankrupt. So you would get the safety nets that are in place for banks being extended to the stablecoin realm, and that is kind of the fear. So then it really is banking, the development of fractional reserve banking all over again with a new name. But if you actually would regulate it and have this regulation in place, that stablecoin should be backed by really safe assets, then it could be a promising new innovation, I think.
But what's promising about it? Because in my mind, I have never seen a stablecoin outside of the crypto realm. I have not seen it yet. Maybe I'm just not fully in it. But in my mind, it's like, okay, why would I want a stablecoin if it pays no interest? I think some stablecoins also pay interest. They some pay, I think, way higher interest rate than the treasury bills do, which should not be possible if it's a full reserve bank. But then, okay, the ones that maybe don't pay interest rate, why do people have them? Because it makes it easier to trade in crypto, because they are plugged into the crypto ecosystem. You can build decentralized financial applications back on the back of them. But what outside of that? Then aren't we just again back to having a full reserve bank, which we just discussed with the current deposit guarantee schemes in place, is not feasible?
Yeah, I agree with you, but I see central bankers warning about stablecoins becoming systemic all all around us. So I'm just watching what will happen, but I find the discussion interesting, and I agree with you. I don't see why regular people who don't want to trade in crypto are going to move their bank money to stablecoins, convert bank money to stablecoins. So I don't see it happening that quickly either. But I think it's interesting that the central banks and banks are afraid that this will happen, and therefore now have kind of woken up to the digitalization of money, and therefore we now have an interesting debate about the layering of our system. And I find it also funny that central banks are warning about bank run risks on stable coins, while completely neglecting the fact that bank run risks on banks are still there. And so they warn for something that they perceive in stable coins, which is, well, if you would be honest, you would acknowledge that it's still happening in your own system as well, but somehow they don't talk about that. So it kind of the sort of hypocrisy of this debate makes it funny as well.
I could imagine that what plays into that is that they have all of these rules and regulations in place for banks, but they don't for stable coins. But I do think it's an interesting maybe bridge to talk about central bank digital currencies, because as you mentioned, one interesting thing about stable coins is it woke up the central banks to maybe, let's say, full reserve banking as a concept. And as we discussed, that's a sister concept perhaps of central bank CBDC, central bank digital currencies, precisely because it's about, look, we no longer want to bail out the banks. CBDC could also play that role, right? If you want safe money, you have a CBDC account. You have still the benefits of digital money that you can pay in any store with a card or with your phone or whatever. And then we get rid of the deposit insurance scheme, and the banks can just take risks again like a normal market. That may be the ideal vision. Is that
where you would have a central bank digital currency, then would be the safe money, like banknotes, but in a digital form, no credit risk. To me, it makes sense to say, okay, we're going to introduce that. Maybe we have a small holding limit at the start, but the goal is to increase that limit so people can have this account for safe money. And then we don't need deposit insurance on bank money anymore. So it would be a step to separate the public payment and saving system from everything that is investment and risk. And then you have a backup system that still keeps running when banks go bankrupt. And it would also, it would redefine these banks, because they would have a different financing structure. And I think it would be healthy to at least discuss that. But somehow in the debate, this is what the kind of the campaigners have been saying, and scholars have been pointing out that this would be a great opportunity to restore this balance between public money and private money, because in the digital world right now everything is private money. Bank money is private money, and it grew a lot because there was just no public money in the digital form, and banknotes are not really handy if you want to pay online. But right now the discussion, like the goals of the digital euro, for example, have been narrowed down so much that they just focus on payments. So you would have a limit of 3,000 euros. And the only goal is to have a public payment option. But critics say, yeah, well, just payments that's not a function of money. You would at least need to be able to store some money on your account. Why otherwise are you going to use it for payments if you cannot even receive your salary and keep a few months of salary on this account? And I think the important reason for that is that the banks have been lobbying at the central bank, at the European Commission, in the Parliament, and they've been saying, okay, central bank digital currency, that's going to ruin us because it's going to drain our funding, and we will not be able to provide the economy with credit, and you are going to pay much more for your mortgage. So it's a very bad idea. That's basically the lobby.
Aren't they right? Partially. I mean, that's also, isn't it also, if we're honest, a little bit what these groups are campaigning for more public money. That automatically means, well, not in all cases, but typically would mean less private money, less funding for cheap funding for banks. I mean, you've talked about this.
Yeah.
That's also isn't that also what you want, actually?
Yeah. So it's partly they are. I think they're partly right, but they think it's a bad thing, while the campaigners are saying it's a good thing. And they're partly exaggerating like the consequences, as if banking would be destroyed. And I think that's a big overestimation. I think it would be possible for banks to fund themselves in another way, maybe a little more expensive. But then there's also this question, is all this cheap credit, is this really a good idea, or should some credit be more expensive? Because it's actually risky, and maybe it's not such a good idea to have all this really cheap debt flowing into the market. So I think they're partly right, and it's mostly a difference of perspective, whether the current system is great for our society or not, and that's what we started this conversation with.
Yeah. So this maybe leads us a little bit into the political backlash. Like, as we've discussed, we've seen these reform plans. There are different possibilities: full reserve banks, CBDC, or just rules on what credit can be created for and what it cannot be. All of that obviously has a big impact on banks, perhaps on other parties as well. You mentioned European bank lobbying against the digital euro. Do you have other juicy or interesting examples of political backlash in your book?
Yeah, I think one of the chapters is about the US and the academic Sol Omarova. She's originally from Kazakhstan, and she wrote some really interesting papers on these topics of monetary reform, and she was a lawyer on Wall Street, so she knows all the technical details of these contracts and financial products. And through her work, she gained some reputation, and then the Biden administration wanted to appoint her as the highest bank regulator of the U.S. And that she needed to be approved by Parliament and Congress, and there was this hearing. And before this hearing, there was in the media, there was just so much, just bad press on her. It was really going really low, calling her a communist just because she had a background being from Kazakhstan originally. So that was really character assassination, and that worked in the end. And there you could really see, okay, if there's someone who has the ability, because she's not just an idealist, but she knew her stuff, and she knew the technicalities, and she knew the law, and she would have definitely repaired some of the loopholes that are now being used to take a lot of risks and by banks with other people's money. And she would have closed these loopholes, and she knew how to do that. And that's a real threat. And then you see, okay, at such a point, the banking lobby can really become very nasty, and especially in the US, that was paired with these items on Fox News, and it worked. She had to step down in the end. She even got threats at her house, and yes, was a very traumatic experience. So I wrote down her experience, and I think that is also happening in Europe, but to a much it's more friendly, I think. So in Europe, it's not. I didn't hear about any threats or things like that. It's just there are too many lobbyists in comparison to public campaigners. So it's on one NGO who's working in this field, you have 40 lobbyists from the financial sector. So the politicians in Europe are just having so many conversations with these lobbyists and with the bankers and with the central bankers, and they all are part of this one group who just thinks within the current system. And people, I talk to a lot of central bankers as well on background, and they admit that they are part of this group think, and it should actually be there should be more challengers around to open up the debate, but it's not really happening. So it's more the funding of the bank lobby is just huge, and there's too many people who are thinking within the current system, and it also requires some stepping out and being able to think about things differently, and you cannot do that if you are always right in the middle of this system. And that's also why a lot of former central bankers and former bankers became reformers after they retired, and that's also a trend I observed. So a few of the characters in the book are former officials who became different thinkers after they retired, because then they had the ability to step away from the daily practice.
Like who?
Like the former central banker, the central bank president of Spain, Miguel Fernandez Ordóñez. So he was there when the banking crisis of 2008 happened, and he was part of the Financial Stability Board when the Basel III rules for banking were formulated. And back then he was just like all the other central bankers. Well, we need higher capital requirements, and that will fix the problem. And after he retired, he really started reading the papers of Positive Money, of Ons Geld, of the Bank of England about money creation. And then he realized, okay, maybe we've been focusing on the wrong things. We really need fundamental reform. We need to we need to make sure that banks can no longer fund themselves with deposits and profit from the subsidies of the safety nets. So that's really quite a turn from where he came from. And he's now campaigning for the digital euro as a first step of achieving that system. And he makes an interesting point, saying also that especially here in the eurozone, we have one coin, but it's only the physical euro notes that are the same in every country, because all your bank money is depending on how safe is your bank and how safe is your government. Is your government able to backstop the banks? So only if we have a digital euro created by the European Central Bank, that will allow all European citizens to have the same digital euro in their wallets, and that will be the ultimate step of creating this monetary union.
What do you think about the critics of CBDCs? Obviously, you have the banks and some central bankers, at least a few years ago, but mostly not now. The bank lobby would say, look, this is bad for financial stability. And then, second point, maybe also we can't create as much credit then for the economy. But you also have a very strong backlash against CBDCs about privacy and having the government stay out of money. What do you think about those criticisms?
I think it's a valid point that everything digital has a risk for privacy. There's a concern for privacy there, because it's digital. So especially if you have a limit on your account, that means your account needs to be registered on your name. There's transactions, and even, well, there's always a possibility to track transactions, which is not possible with banknotes. So we should be aware of that, and there should be laws that prevent this from happening. And I actually think that this is now, because it has become such a big point in the discussions, this is actually one of the best parts in the draft law, that they are paying attention to privacy. And I think the digital euro, if it will come, it will be much better on privacy than bank money, because banks register everything you do with your money, so all your payments are tracked. And also for the skeptics, kind of during the COVID protesters in the COVID protests in Canada, where the truckers had their bank accounts frozen, that was all happening within the current system. So if you have government that overreaches, it can use the current system for that as well. So I don't think you need CBDC to do that, and I actually think that the current design of the digital euro would prevent this from happening. And I think it's also a little exaggerated, like the total control that can only happen if CBDC would be the only money that you can use for payments. And I don't think that is anywhere near. So you will have private payment options. And I think that's also a good ecosystem where private solutions will kind of discipline the government from overreaching, because otherwise nobody would want to use the public money anymore. So I think that's there's too much debate, I think, on the privacy issue, and too little debate about how this could ultimately make the system safer if you have a plan for it. But you need to acknowledge that the current banking system is unstable by design. This is inherently unstable. And then you need to build something safer next to it. And I think the argument, if you build something safer, then people will go to the safe system, and the unstable system will collapse. That is a very bad argument, because it keeps us stuck within the status quo. And I understand it from the bank's perspective, because they don't want to lose their cheap funding. But I don't believe that is a valid argument if you look at it from a policy perspective and zoom out a little bit. You need to think about how can we improve the system, make it more stable. And I think there CBDC could be a nice first step. And I think this debate should be part of political discussions, because right now we are having this conversation and central bankers are talking about it. So in the rooms somewhere in the central banks and banks, these discussions are being held, but it's not a topic that you hear a lot about in the political arena.
I could imagine it's just not concrete enough for people. Like, I could imagine for a political campaign, you need to be really relentless on saying, look, no more bailouts, no more bailouts, no more bailouts, because that seems to be the central problem that most of these solutions are tackling, right?
Yeah, and it's no more bailouts, but the problem is that bailouts, then we only see them at these really crisis moments, but the continuous safety nets are the real problem. They are creating this moral hazard. They are encouraging risk taking. They are, as Anat Atmati is also a scholar that I spoke to. She just describes it's a public subsidy for banks to create loans and take more risk than they would otherwise do, and that risk is still there, but it's not being borne by the people who are involved in this loan. It's not the bank and the borrower, and that's where it should be priced in and not be transferred to the general public. And I think this is really an important thing that that relates to a lot of other problems in our society, where we say, okay, we need to have, for example, an energy transition. Therefore, we need to funnel more money to this particular kind of companies. Well, why not? If we take away the generic subsidy on all sorts of credit and just focus it on a certain type of credit, I think that would be much more in line with other political goals, and therefore it should be in the interest of politicians who are campaigning for an energy transition, for example.
Interesting. So do you mean then how does that work? Like, does the central bank then say if banks lend to, I don't know, a solar producer, they get less, they are judged to be less risky, or they get certain privileges, or
Yeah, and
what does it concretely mean?
that's happening right now already. Huh? These kind of discussions you can have on where does credit go, but I think like it's just in isolation we talk about this topic, so maybe it wasn't the best example. But I think we should acknowledge that the current system is just subsidizing all sorts of credits, also the bad kinds, and yeah, these acknowledgements need to come first, and then we can talk about how do you want to redesign this? What kind of things do you want to subsidize? What kind of credit is useful for society? Is it just this green transition, or do we want to subsidize small and medium enterprise credit? I think that would be like a valid answer to the claim by banks. Well, if CBDC drains our funding, then all credit will be more expensive, and the economy will come crashing down. I think you should then open the discussion and say, okay, well, right now we subsidize all sorts of credit. We're gonna change the system. So it's not valid to say the whole thing will come down and there's no credit available for productive investment in the economy.
So what would you've done a lot of research on this. I think you've also been involved in the campaigning part a little bit here and there. What based on all of that knowledge right now, what would the ideal monetary system look like?
Yeah. I haven't been campaigning for anything, but I followed these campaign movements from really close, and by writing about them, of course, I focused attention on their campaigns. And I also think I wouldn't have written about them if I thought they were just saying bullshit. I think there's a point in these campaigns because they point out a lot of the flaws within the current system. I think the first step would be to acknowledge that in the digital world, we have seen a shift from public to private money. So the balance of public and private has been tilted towards private monies. And I think the central bank and politicians need to acknowledge that this is not a natural balance that we have right now, where 90% of or more of the money is private money. So with central bank digital currency, if you introduce that, there should be a goal of restoring the balance and making public money more important again. And like some of these campaigners have been saying, oh, we should have just public money, and I don't think that would be kind of the extreme. But I think it would be fair to say, okay, in the past, 50% of the money was public money. Maybe we should go back to 30% right now. That would be the goal in 15 years or 10 years. Yeah, that would be a first step, which is not being done right now. It's just the central bank let the privatization happen and now has no explicit goal of restoring public money. And I think that's also why they are failing to convince the broader audience of the use of this public money, because they are so they don't dare to actually say these
They
things
don't say it,
because they're always concerned about financial stability, which in the current system means banking stability. So they don't want to say anything that could hurt the banks. So that makes the debate really difficult. So I think it needs to come from the political spectrum. Politicians need to start saying this. We need to restore the balance of public and private money. And I also believe that if we don't do that, the private sector will keep developing, and stable coins, especially stable coins issued by these big tech companies. So Facebook, for example, that was also the big eye opener in 2019 when they announced their own stable coin Libra back then. Then you would go outside of the crypto realm, something we discussed before. If you have a big social media platform having their own stable coin, then it could become a means of payment in the wider economy, and that would really also be a threat to the current banking system. So yeah, in this sort of arena, this right now have the banks, that's the status quo. Then you have the new challengers from outside, the tech companies, the stablecoin issuers. They want to have a part of the pie, but they're private companies as well, and they're unregulated outside of the banking realm. And then you have the central banks who are who can need to define the public answer, but they are very wary to do anything that would hurt the banks. So yeah, I think people from outside of that realm, like the politicians, that's where we have we are democracy, so it should be the politicians who decide what kind of financial system we have, should come in and say, okay, we want to restore this balance. Banks, you've had your time. We now are going to develop public money, and we somehow also open up to other challengers if they provide good services. And then you should also extend the regulation, so not just regulate banks, but also regulate stablecoins in a thought through manner, so they will actually be stable. And I think that is where the developments are happening right now. And then next phase would be, okay, have a more open discussion about money creation. What is the money creation that is beneficial to society? And there you have, if you restore the system, have digital public money, you can also have new instruments for monetary policy. You can create public money and give every citizen 500 euros if you want to stimulate the economy, instead of pouring it all into the financial system.
Banking system. Yeah.
What we've done with quantitative easing. So that would open up a new discussion about what is monetary policy, what are the goals of monetary policy, and not just inflation, but also to see where new money is actually going to, and what new instruments can you use if you have a CBDC. And I don't see why you wouldn't have this discussion, because there's new technical options available that allow for a different design of the system, different instruments. And if the outcomes of the current system would have been great, then okay, then I can accept that we would not have a discussion. But we can clearly define that the outcomes of the current system are not so good. They increase inequality. There's a lot of money flowing to bubbles. I think the system is causing a lot of problems. So there's all the reason to have this debate.
So can I summarize it as, okay, look, the current system that we have, we've now discussed, what it looks like. It's mostly private money creation from banks, not so much public anymore. Real shift. Used to be way more public money creation when cash played a bigger role. The downsides are instability, inherent instability, not the right credit allocation, I guess, anymore, right? It's going too much towards speculation and bubbles, and then there's subsidies to banks, massive subsidies to banks, which we ideally don't want.
Yeah.
So that's the problem with the current system.
Yeah, and
Am I forgetting something?
And adding to the credit allocation, like it's not private credit. It's because you can create new money. It's public money that is being allocated. Because if it would be a purely private system where you put in, it's private persons who put in their money into a fund and then loan it out to a startup because they believe in the startup, then they bear the risks as well if the startup goes down. But it's important because it's the public money system. It's yeah.
Yeah. To me, that feeds into the I should have maybe said it more clearly, the no more bailouts.
Yeah.
Or bailouts are bad. It's part of the current system. Right. And then you've listed, and then, what I'm taking away from our conversation is that it's not entirely clear what the new system exactly will look like per se. It even sounds like there are multiple options. You could have private reserve banks. You could have a bigger role for CBDC. You could have tighter regulation on banks where maybe, they still do a lot of the monetary functions, but are not allowed to take risks as much anymore than if they want the subsidy, essentially. And your favorite seems to, as you seem to be leaning a bit towards CBDCs, at least making public money more viable again.
Yeah. Yeah, I've maybe it's because I've been writing about this topic for a long time, so I also have the political landscape in mind when I'm talk about these solutions, and I'm seeing that certain reforms, which in an ideal world may work really well, are just so far away from the current system that I focus on the things that are practical as well. So right now, I think this discussion on central bank digital currency is at least that is taking place. So that's where the big choices could be made right now, and that's why I think it's practical to define at least a vision on that part of the innovations.
Yeah. Okay, that's fair enough. It's politically more feasible than full reserve banking right now.
And I, all these alternatives, they're all possible. So that's why I don't say, okay, this is like the ideal. All have flaws. All have, there are risks there as well. But I think the current system is just such a bad design that I think all these other options would be an improvement, and maybe we can combine them as well. I think that we should be more open to these other solutions, and without picking an absolute winner. I don't think there is an absolute winner. I think there are multiple options who are all better than what we have right now, and we should start experimenting. And I'm also practical in it. Let's focus on the things that are on the table right now. But
fair enough.
I'm a journalist, so I'm writing about what I see, and of course I have my personal preferences, but my first driver is interest in what can be done, and to decipher what is happening, and also talk about the political debate and discussion and landscape and the forces.
So your book is then really for the people who want to know how the system works and want to know way more about all the options that are on the table, and finally a little bit about the political backlash and the political intrigue and the players involved, mostly in the Netherlands, I think, right?
I focus on an international audience. So the book is,
okay.
I talk about the Dutch group, Ons Geld and Full Reserve, but also Vol Geld, Positive Money, Anatat Mati, Fernandez Ordóñez plays a big role in the book. So I go to people in the US and Germany. So it's really an international story. I wanted to tell all these stories, and it was also nice to pick out the people with the most interesting personal experiences to explain part of the current system. And yeah, it's now out in Dutch, and it will be translated to German and Spanish. And we're still waiting for an English publisher to buy the rights, because I would love to bring it out in English, of course.
All right. Hopefully, a publisher may be listening and calling you right after. But in the meantime, I'll link the books in the description of this podcast. And thank you so much for coming on, Thomas. I thought that was a really broad, encompassing, monetary, and really interesting discussion. Thank you so much.
Oh, my pleasure. Thank you.